Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stocks chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is Steelcast Ltd. So let's see the business. So Steelcast Ltd is the leading manufacturer of high quality steel castings, serving a diverse range of industries, including construction, mining, and earth moving equipment, with new ventures into railroad, ground engaging tools, and defense. Now, let's look at the broader industry landscape. As you can see from the chart, the global steel casting market is on a robust growth trajectory. It was valued at approximately $177 billion in 2024, and it is projected to grow at a CAGR of around almost 7% and reach $325 billion in 2033. On the other hand, the Indian steel casting markets was valued at approximately 25.5 billion in 2025 and is projected to grow at a CAGR of 11.13% and reach $42 billion in 2030. The growth is being fueled by several key drivers, such as diversified supply chains and China plus one strategy. So global companies are actively de-risking their supply chains by moving manufacturing and sourcing away from China and towards other reliable partners. This is a significant tailwind for companies like Steelcast. On this slide, we detail the core industry that our company caters to. The company specializes in manufacturing high quality steel castings and components that are critical for heavy machinery. Their primary end user industries include earth moving and construction, mining, electro locomotive, transportation, cement, and construction. Building on their core business, Steelcast is aggressively de-risking its portfolio by entering new high-growth segments. This is a key part of their long-term strategy. GET, which is ground engaging tools, is a key growth driver with over 3 dozen new components currently under development. This focus on GET is a major part of the company's plan for diversification and growth. Second, railroad. The company is working on a critical railroad component for the American market. While the failed trains have faced some issues, management is still optimistic about its success, giving it an 85% probability. This project has the potential to add approximately 25 crore in revenue for current financial year if approved. Lastly, we have defense. Steelcast have achieved a small breakthrough in defense exports. They have successfully supplied prototypes that passed field trials, and a new batch will be shipped soon. This single component has the potential to generate about 10 crore in annual revenue with opportunity to scale up further. Now, this slide gives us a breakdown of company's revenue contribution. First, if we say segment wise, then OEM sales is 100% of our business. And next, if you say a geographic mix, so the company has a well balanced revenue mix with exports making up 54% of sales and domestic sales contributing 46% as of Q1 FY26. This balance is a key part of the strategy to de-risk the business. Looking more specifically at key regions, North America is expected to contribute between 130 to 135 crore, while Europe is projected to bring in between 140 to 145 crore for the year. Industry-wise contribution, the bulk of revenue still comes from their core earth-moving construction and mining industries. However, new segments are starting to contribute, with the US railroad business already contributing a small amount of sales, which is expected to grow. The company's goal is to have the new GAT segment contribute 7 to 8% of the sales over time. Product-wide contribution, a significant portion of the growth has been driven by new parts that have been developed and approved. moving from the sampling stage to serial supplies. On this slide, we can see our company's global footprint. The company is not reliant on single market, whether it has diversified presence across 16 countries, and they are expecting to increase it to 18 plus countries in the next 1 2 years. The company has a strong foundation in its core markets of North America and Europe. Beyond this, they are seeing significant momentum and growth in Eastern European countries like Poland and Slovakia, which are becoming increasingly important. They also have successfully established presence in new markets like Brazil and Canada. The company's goal is to continue to expand its global reach and plans to add one more country in the coming quarters to further de-risk its business. Now let's get into the historical performance. In this, if you see for the last 2 year financial years, the revenue has declined. So there were three primary reasons for this revenue dip. First, global inventory liquidation. The most significant factor was widespread inventory liquidation by customers and their dealers, especially in key markets like North America and Europe. They had built up excess stock in previous periods and spent approximately 6 to 8 quarters consuming this inventory before placing fresh orders. So this was a cyclical market phenomena. Second reason is geopolitical and economic headwinds. Several global factors compounded this issue. The ongoing geopolitical conflicts and high interest environment created uncertainty, leading customers to delay their investment and purchasing decisions. Lastly, end user industry slowdown. So both domestic and international demand from mining and construction equipment sectors, which is our company's core customers, slowed down. This was due to a combination of factors, including global economic conditions and a temporary slowdown in new project awards in India. It is important to note that this revenue decline was primarily volume driven and not price driven. The management's strategic response to this challenging period was to maintain focus on margin protection through cost optimization, accelerate efforts to diversify into new segments like railways and defense, and expand its global presence, which positions the company well for a strong recovery. So let's look at the key takeaways. So the company is confident of an 18 to 20% growth for FY26 despite a slowdown in customer decision making due to US tariffs and geopolitical issues. They have also revised their capacity utilization guidance from for the year from 59% to 53%, and they aim to reach 65 to 66% by FY27 and 84% by FY28. Next, the company is actively pursuing new business in its railroad, jet, and defense sector to de-risk its business. The specifics of this I have mentioned previously. And next, if you see, management has clarified that the high EBITDA margin of 31.7% in Q4 of FY25 was an aberration due to one-time benefits. The sustainable EBITDA margin for next 2 to 3 years is expected to be around 25 to 26%. Cost and capex. The company is investing in a 2.4 megawatt hybrid power plant to be commissioned by the end of FY26, which is expected to yield annual cost savings of around 3.5 to 4 crores. The capex of which is planned of around 38 crores for FY26 is on track. Next, the company is seeing momentum in Eastern Europe, has a presence in Brazil and Canada, and is exporting to 18 countries with plans to add another. The China plus one strategy and US tariffs on Chinese goods are seen as a significant long-term opportunity for the Indian exporters like Steelcast. The sales prices are on a cost plus X works basis, so customer absorb any additional tariffs. Now let's see the bull case. So the first trigger for our business is the company successful. If the company successfully secures approval for its American railroad component and begins serial supplies, adding a significant revenue stream. At the same time, the new GAT components in the defense export scale up as planned, further diversifying the revenue base and driving growth. Second trigger is the company's capacity utilization increases as guided from 53% in FY26 to 84% in FY28. This higher utilization leads to operating leverage and sustained profitability, with the EBITDA margin remaining in the upper range of guided 25 to 26%. Third can be market share gains. So the US tariffs on Chinese goods, which create a 30 to 35% differential in duties, coupled with the China plus one strategy, allows steel cars to capture substantial market share from its competitors in key export market. But this point is very subjective if I have to tell you that, because as Trump is constantly putting tariffs and he is changing his decision, so it is very hard to predict whether this will be a trigger point for a company in the future. But moving on, the last trigger point can be cost efficiency. The new hybrid power plant is commissioned on time, leading to projected 3.5 to 4 crore in annual savings and helping to maintain strong margins. Next, we have the bear case. The approval process for the American Railroad component continues to be delayed or fails, removing a major expected growth driver for the company's outlook. Other new initiatives like gas and defense also can fail to materialize into significant revenue stream. Second, bear case can be the government or global economic slowdown, geopolitical conflicts and uncertainties persist, prolonging the destocking cycle and muting demand beyond the company's Q3 FY26 expectation. This could prevent Steelcast from achieving its growth and capacity utilization target for FY26 and beyond. Next, margin compression. So, to increase its low capacity utilization, the company is forced to take orders on lower margin, which could pull its sustainable EBITDA margin below the guided level. So, this can also act as a bear case. And lastly, if there is slower diversification, so the efforts to add new countries and new products are slower. If they are slower than anticipated, it can cause the company to be vulnerable to downturn in its existing key markets of North America and Europe. Now, let's see the company through our framework. So, section one, governance and promoter behavior. So, fund-based history. So, recently, in the last 5 to 6 years, they have not done any fundraise or anything, and they have been listed for a long time. So, that is why I gave a 5 and 5 score. Back then, promoter track record. If you see Mr. Chetan Tamboli and the Tamboli family basically has majority of the shareholding. Mr. Chetan Tamboli has a lot of experience. We didn't talk about the management this time, so I can tell you about it now. Mr. Chetan Tamboli has a very good experience and he is the founder of the company. And Rushil Tamboli is the son of Chetan Tamboli, so he's the second generation who has joined the company. So he also is very experienced. Both of them, CEO is Mr. Ashutosh Shukla. If I tell you overall, the management, the promoters, and the executives, key management persons are all very experienced, and it is a very professionally managed company. And I did not find any bad remark about any of them. So that is why I gave a 5 and 5 score. Related party transaction. So there were some donations for CSR totaling about 40 lakhs. So I did not give a lesser score because the amount was very small. And also I think it is for CSR and I did not find any problem in that. So that is why I gave a 5 and 5 score there also because the amount was very small actually. Next, board composition. If you see, as I said, it is a professionally managed company. Out of the 10 directors, 5 are independent, 2 are family on board. So that is why I gave a 5 and 5 score. Remuneration, if you see, remuneration is also very good. As a percentage of sales, it is not very high. So that is why I gave a 5 and 5 score there also. Key person resignation. So only one person, company secretary, had resigned in October of 2021. So it has been 4 years and there is no resignation. So I think it is, so that is why I gave a 5 and 5 score because before that also I did not, there were some resignation, but it was a bit back. So we are considering mostly 4 to 5 years. So I did not find any problem. So I gave a 5 and 5 score. Auditor resignation or change was not there. So I gave a 5 and 5 score. Auditor opinion has been unmodified and credit opinion had also been very stable. So that is why I gave a 5 and 5 score. I did not find any legal or regulatory issue on our company. So I gave a 5 and 5 score. PPTs, con calls, results, everything is there. So there also 5 and 5 score. Section 2, financial health. Business concentration risk is not there. So I gave a 5 score. Cash flow by EBITDA, if you see, it has been very good. It has been very consistent and very good. But right now it is a bit less to give it a 5 score for us. So that is why I gave a 3 score. Receivables by revenue. So receivables as a percentage of revenue, it is a bit higher. So that is why I gave a 3 score. Inventory days and cash conversion cycle, I think I checked with other companies also. So it is approximate with other companies also, it is approximately in this range only. So I think for this industry or this sector, it is this range is normal. So that is why I gave a 5 score in both these metrics. Capex versus revenue, if you say that it is fine, that is not there. Interest coverage ratio is very high. Quick ratio is also good. Current ratio is also good. So I gave a 5 score in three of these metrics. ROE and ROC, if you see, it has been very consistent, very stable, and it is high. So that is why I gave a 5 score. Growth consistency, if you see, EBITDA margins, PAT margins have improved, but there was a degrowth in revenue mostly because it is a cyclical industry. So it has happened mostly because of that. But due to this, I gave a 3 on 5 score there just because of the cyclicity of revenue. And overall, the score comes out to be 94. And for the valuation and final take, I'll hand it over.
What is the growth guidance? Can you tell again?
They are 18 to 20% they are targeting.
Okay, cool. Is my screen visible?
Yes.
Okay. Overall, a really good company in terms of promoter governance. The only two concerns I have is the cyclicality, and everything is linked to the global economic cycle. Currently at PE of 26, they have good ROC, no debt. So these are really good positives. For the last 5 years, it has been a multi-bagger as well, so it's run up quite well. Trump tariff is another thing that needs to be now factored in, but hopefully it normalizes. But in terms of valuation and price, the management is expecting around 15 to 20%. So that falls on, this is lesser, but let's just take bear case as the worst case. Margins, again, management is expecting to maintain because of different factors. And this is showing wrong figure, but you can expect, I would give a PE of 20, which gives the price target on a 1 year forward basis of 901. Currently it's at 1024. So according to me, on a 1 year forward basis, it is with to perfection. So a bit of correction, I would wait for some time and also time the economic growth to get into the stock. A lot of things is dependent on government spending. If we have a longer time frame with cyclical business, it becomes quite tricky. But anyway, let's try. The free cash flow showing as 58 is good. They have done capex in the last 4-5 years and also going up the value added and to new. So let's say the free cash flow, which and the required rate of return of 20 and terminal growth rate of 3 and holding period is 5 and a PE of 15 to be extremely conservative. So the implied growth rate the stock has to grow its earning or cash flows at 35%. The management is guiding for 15 to 20%. But yeah, I think bulk of the capex is done. So let us see how it reacts. So maybe a bit of time-wise correction for a year or two. After that, probably revisit. But yeah, because of a great run up and uncertainties around, I would probably wait for a year and two and see how it plays out.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye-bye.